Hi, I'm Jed with Manual Mortgage. In this video, I'm going to answer your questions about how I pre-approve you for a VA loan, Part 2. So here are the pieces that we have so far. We've determined eligibility and the correct rate for the VA funding fee. And how do we do that? By asking the right questions and, of course, using their certificate of eligibility. Now we're going to tie everything together to get you pre-approved. Now this is going to be a basic pre-approval, and if you have something technical or extra like a bankruptcy or foreclosure or anything that's going to put a kink in the process, we're going to stop and address these concerns first before moving on to the next steps. Now I'm going to do this regardless of the loan type because it's always better to address any kind of problems or concerns before passing go. Now for qualifying, you're going to need the additional items. We're going to need 1 to 2 years of W-2s, pay stubs covering 30 days, and if you receive any other types of income such as retirement from DFAS or the Office of Personnel Management, otherwise known as the OPM, you're going to need the VA Disability Awards letter, which I mentioned in another video. I don't typically ask for because any kind of service-connected disability income is going to show up on your certificate of eligibility. Now, I'd also like to add that a veteran may be eligible for VA compensation for a service-connected disability. However, are receiving retirement pay instead. Now, we're also going to need, we may need 2 months of bank statements to verify any kind of earnest money or funds that might be due at closing. You know, it really depends on how the contract's going to be structured. So, you know, just be aware that you might need bank statements. You know, I also mentioned in a video earlier about eligibility. Income for active duty members who have an ETS date that is less than 2 years of the first payment being due is going to require a letter of explanation stating that you planned on re-enlisting. However, in some cases, this may require a letter from your commanding officer or the personnel department stating eligibility for the applicant to be able to re-enlist. Now, if the active duty member is not eligible the current active duty pay most likely will not be acceptable. The reason why is that pay must be guaranteed for at least 2 years, and if the active duty member does not plan to re-enlist or is just not eligible to re-enlist, it is confirmed that the income is no longer going to continue. Now, once we have all this information, the process is just like any other loan. The veteran or applicant must qualify based on credit and income standards set by the lender. Now, if you don't know what this means that you just have to have acceptable credit scores. And if you watch my other videos, we're always going to be working with credit scores as low as 620, 640, and maybe down to 620. Anything lower or below these scores, we're going to really need to slow down and pay close attention to what's going on. Remember, the income must also be acceptable under the lender guidelines and be sufficient to cover the mortgage payment, which includes taxes and insurance, as well as any other mortgage obligations, monthly obligations, I should say, that are going to show up on your credit report. Now, I'm going to answer your questions on what to look for and how the VA qualifying process is different from conventional and FHA financing. Now, lender requirements may vary, and this is going to be a good time to actually insert a disclaimer. This is what I look for and the few steps that I take when reviewing a loan application for a VA loan. Now, here are some of the differences that'll help your chances for an approval. Now, remember, on a VA loan, credit is a little bit more relaxed, and here's a mini pro tip. For example, collections. With any amount of balance, whether it's $1,000 or $2,000 or more, do not need to be counted against the debt ratios or included in the debt ratios. Another mini pro tip, student loans need not to be factored into the debt ratio if we have proved that the student loan debt will be deferred more than 12 months after the date of the closing. Now, conventional and FHA loans, regardless of the deferment, a payment must be calculated and counted against the debt ratio. Now, here are some differences that could set back your chances for an approval. If this is applicable, child care costs like daycare will need to be calculated as a monthly obligation and counted against your debt ratio. Now, child care costs are typically discovered on tax returns that have been submitted or on a VA document for child care costs. The next thing that always needs to be completed is the VA residual income worksheet. Now, why is this so important, and how does it affect your chances for approval? Well, aside from including the items that show up on your credit report, these amounts must be included in your income worksheet. You need to include 14 cents per square foot. That must be included for utilities and maintenance costs. Your FICA and state taxes need to be included. Child care and child support deductions must be included. And it doesn't matter if you have a 30% debt to income ratio. If the veteran's residual income is less than the VA requirement, the loan is going to be denied. Now, if the debt ratio is over 41%, the VA residual income increases, which makes it more difficult to obtain an approval. And this is why it's so important to complete a VA residual income worksheet on every application. Now, I'm going to give you a huge pro tip that could actually make you a loan hero and put the veteran in a better financial position. Now, a VA loan has a maximum of 4% seller contributions. For example, the average sales price here in Houston, which is around $334,000, if the full 4% is negotiated, translating to a little more than $13,300, any amount that's negotiated can be used to pay off any obligations on the credit report. Here's an example. So if a veteran has a $600 car payment and it has a balance of $13,300 or less, the seller contributions can be used to eliminate that payment. Now, this can be the difference between a declined loan and an experienced lender using these contributions to decrease the debt to income ratio and, more importantly, increase the amount of residual income. Now, we've been able to tie in eligibility, the funding fee, and have reviewed credit by paying close attention and excluding any kind of collections and student loans that are deferred more than 12 months after the date of closing. We've reviewed the veteran's type of income that's going to be used, considered any kind of child care or child support expenses that must be included and counted against the debt ratios. We've completed the VA residual income worksheet, which summarizes the loan application and justifies a solid case for an approval for a VA financing. I know that there's a lot of information here to digest. I want to make sure that you're better educated, and I hope that you found some value in this video. And don't forget to give us a thumbs up if you've learned just one thing, and please subscribe to my channel. Big shout out to U.S. Army veteran and customer and friend Dexter Allen. I appreciate your kindness and congratulations on your new home.